All right, everybody. Thanks for joining us today. My name is Guy Lehman. I'm an owner and advisor here at Compass Financial. And today we're going to be talking about the state of long-term care insurance. And towards the end, we're going to be talking about some other long-term care considerations. I have Jerry Gray from BCH Insurance Brokers here with us. Jerry Gray heads up a group over there that we work with here at Compass to help us with our insurance needs. And Jerry, we've been leaning on Jerry for a long time to help guide us through this long-term care insurance changes in the market. We're going to talk about a lot of those changes today. And we're also going to talk about how the insurance industry has changed over the years to change their products over the years to combat this long-term care insurance thing going on. So Jerry's going to be coming in quite a bit here in a little bit, but I'm going to start us out by saying thank you and welcome. You'll see on your screen there, if you have questions throughout this, there's an email address there, caleb.pearson@compassiowa.com, or you may text your questions to 515-327-1020. And so if we do have any questions come through, we'll answer those at the end. I'm expecting this to be about 45 minutes long today, and depending on where it goes, we'll just try to be respectful of your time. So the first thing that we're going to start is, what is long-term care? And long-term care is often defined, especially in the insurance world, as needing help with activities of daily living. They're called ADLs, or significant cognitive impairment as defined by a doctor. Now, what is significant cognitive impairment? Because it's one of these two things that actually qualifies for coverage under insurance. Long-term care activities of daily living, or long-term care for significant cognitive impairment. And that's really changes that impact daily life. Memory, language, judgment, those are the things that a doctor is going to look at to determine whether there's significant cognitive impairment. And frankly, those spill over into the activities of daily living, which, as you see below, is there's 7 of them: eating, bathing, dressing, transferring, like getting in and out of a car, getting in and out of a house, getting in and out of a shower or bathtub. There's walking, toileting, and taking medications. So if someone can do all those activities, the insurance policy would say they're not on claim yet. They don't need help with those activities. But if they can't do those on their own, that's where we start getting into the long-term care. So long-term care actually has a wide range of services, from personal, like someone actually coming in your home and being a companion, or doing simple things like cleaning dishes or folding laundry. There's also social services as far as adult daycare or community service. And medical, of course, gets into nursing care, going down that route. And frankly, in a variety of settings: in-home, community, I already talked about, assisted living facilities, skilled nursing facilities, as those are commonly known as nursing homes. So there's a lot of areas that long-term care actually takes place. So who is most at risk? Well, very naturally, it's people 80 years and older. Very common, get into needing some sort of long-term care. Women, because they tend to live longer than men, also are at high risk. Another big risk factor is chronic health problems, diabetes, heart disease, things like that. It makes those activities of daily living a lot tougher to do on their own. And frankly, who's most at risk is those that lack the social support, either family or a friend group or a church group or a community group, to support them in their age. Basically, unpaid caregivers. So the people that don't have the social network and that are elderly with chronic health issues are the ones most at risk here. So here's a little bit of data from longtermcare.gov. On average, someone who is 65 years old today will need some type of care for about 3 years. Now, 20% of people will need some type of care for more than 5 years. And you can see there the severe cognitive issues, when those start creeping in, it increases the chance at a lengthy period of time that they need care. So interesting information, but on average, the typical 65-year-old is going to need care in the area of 3 years. Unpaid family caregivers, spouses, aunts and uncles, kids typically provide a majority of the long-term care in this country, 70 to 80%. Again, this is off longtermcare.gov. And that isn't particularly surprising, especially as we go on. We're going to see this unpaid family caregivers pop into the equation quite often. But nationally, long-term care insurance only covers about 5 to 7% of all the costs being incurred for that care. Now, for those 5 to 7% of the people that have long-term care insurance and they're receiving those benefits, that's pretty significant. It pays for a lot of care. But again, majority of the care happening is not being paid for. It's through unpaid family caregivers. So now we kind of get to the main part of this presentation is, how do you insure against the cost of long-term care? And there's really 4 ways to do it. There's traditional long-term care insurance. There is hybrid insurance, also known as asset-based insurance. And you're going to hear that term come up a lot. There is life insurance with a long-term care rider, or basically an additional provision on the policy. And we'll talk about that. An additional provision on a life insurance policy. We'll talk about how that works in a little bit. And the last way that people insure against this is self-insurance. And we're going to talk about that too. So we're going to cover each of these, I hope at a high level. And then I'm going to be peppering Jerry with some questions about what he sees practically happening in the marketplace, what he sees people doing successfully in handling this sort of insurance. So we're going to cover the pros and cons of each. So the first one is traditional long-term insurance pros. So think about insurance. The whole concept of insurance is everybody pays a small premium. The small premiums of the many pay for the large claims of the few. At least that's traditionally how it works in insurance. Long-term care insurance has gotten really distorted over the last 25 or 30 years, and we're going to talk about that too. But typically, a traditional long-term care policy, you have smaller payments now, and those payments might be monthly, they might be annual payments. There's immediate coverage once you get the policy in force, and the coverages are typically quite extensive. And there's all sorts of options. So you can do inflation protection, and you can do flexible premium stuff. So there is some flexibility there. Now, remember, long-term care insurance policies do contain exclusions, limitations, and basically they're going to determine qualification for benefits on a case-by-case basis. That's called underwriting. They take all your information, they ask you a lot of health questions, and they determine whether you can get insurance or whether they're going to deny writing insurance for you as a customer based on your history. And again, for costs and details, if you want to dig into this, please give us a call. We'd love to walk through this process with you. So there's some pros. There's also some cons of traditional long-term care insurance. For some people, it can be prohibitively expensive. And part of the reason is that costs can go up over time. It's not locked in, it's not fixed. So let me tell you a little story from me personally. I went through all this with my mom. She had a long-term care policy that was bought back in the 90s. And back then, very similar to insuring your house. If you would pay $1,000 in premium to insure a $300,000 house, right? That people kind of get that, right? A low premium to cover a pretty pricey object. And that's the way long-term care was back in the 90s. So she had a very reasonable policy. She paid into for 10 years, and she had a very healthy, actually an unlimited benefit. And so back then, if you put $1 into this type of policy, you might eventually reap $25 or $30 of benefit. Okay. That's all changed because of the experience of long-term care. It's gotten really expensive. It's gone up about 6% every year for the last 25 years. So it continues to get expensive more quickly than other things. And so in the meantime, insurance companies have made it a lot more expensive how much you're paying in. And they've put all sorts of limitations on how much those policies pay out. So now, if you pay $1 in, you may reap $2 or $3 under benefit, but that's about it. Jerry, what are you seeing in this area?
Yeah, I think that does hold true. So typically, Guy mentioned it in the past, they did have lifetime benefits on policies. That's very difficult to get today. And then on as it relates to the price increases, as he mentioned, it's gotten very expensive to go into a long-term care facility. So there's a variety of different ways that you can design these policies that we'll get into shortly. But the bottom line is it's a protection of your assets. It's a protection of your assets, which you're really trying to accomplish, that goes on to the next generation.
It's also a way, some people get disappointed when they go through the claims process and their long-term insurance starts paying out, because they're like, man, I just expected this to pay for a lot more. And as advisors, we're like, I think the best that long-term care can do is take the edge off of long-term care costs. It's going to be very difficult to insure yourself, to insulate yourself totally from long-term care costs, but it makes it less painful.
Yes.
In the time. So the traditional long-term care insurance cons, there's also extensive underwriting. Tell me about that.
Yeah, so with the traditional policies, typically they're going to have to go through an exam, which would be a nurse would come out and ask the medical questions, and then more than likely they're going to do a blood and urine. They're going to want to make sure there's no issues there. And then also the insurance company will do a cognitive screen. They're going to want to make sure there's no memory issues going on. So it's a little bit more extensive with traditional long-term care. If you go some of the other routes that we're going to talk about today, there are not exams involved, and many times they do not order medical records. So it's a more streamlined way to do underwriting. And a lot of the clients love that aspect of it. And that's why a lot of clients are really moving away from traditional long-term care. There's still reasons to buy traditional long-term care, and that's why it's out there. Yeah. But there's some other ways to buy it today that are less intrusive for the client as it relates to the underwriting process.
Yeah, and one of the last cons I'm going to talk about with the traditional long-term care is it's if you don't use it, you lose it.
Right.
And that's a thing that people don't really like. Hey, I paid into this policy for the last 30 years, and there's a chance that I might not even use it.
Yep.
What a waste of money.
Yep.
So people don't like that. It's almost like betting against yourself, like betting you're going to get sick. So I need to keep this policy in force. So again, there's other ways to kind of get around that in these other types of options. Okay, now we're going to go on to the second major type of insurance, long-term care insurance, is hybrid policy, are also known as asset-based. So these hybrid policies combine long-term care coverage with either an annuity or a life insurance. Okay. The long-term care benefit. So if the long-term care benefit is unused, then the asset itself is passed along to heirs. So it kind of gets around the thing that people don't like about traditional long-term care. And as you said, there's more relaxed underwriting. So what are the other pros that you see for the hybrid or the asset-based policies?
Yeah, so these are really newer products in the industry. They've only been around, for the most part, I would say 10 carriers in the last 10 years have entered this market. So it's a newer product. A lot of clients don't really know that it's out there. So typically what I'm seeing is a lot of clients transitioning to those type of products. Number one, we talked about the more relaxed underwriting. The other thing is that, you know, the asset you talked about being passed to the heirs. With traditional long-term care, like you said, if you never use it, it's gone. Well, with these new plans, if you never use the long-term care for home health care, or you go into a facility, there's options for return of premium. Or if you pass away, you never used your long-term care benefit, a death benefit's going to go to your heirs, to your beneficiaries.
Okay.
So one way or another, something's coming out of that policy versus traditional long-term care. And the age-old objection has always been with traditional long-term care, has been that advisors for 30 years have been hearing it. If I never use it, I'm going to lose it. And I don't have that comfort level that my premium is going to stay level throughout the life of the contract. So with the hybrid policies, that's something you get with those as well, whatever premium you pay from day one, that premium will never change. So you get peace of mind with that.
Good. Let's talk about that, because the old traditional long-term care insurance is based on paying over a long period of time, right? Paying monthly or paying annually, over long time. This hybrid policy, also known as the asset-based, is more of a lump sum payment, right?
There's different ways to design it. When these products were initially designed, they were all single premium products.
So you had to put a chunk of money down, and all your benefit derived from how much you put down.
Correct.
Yeah.
So usually what we would see was a client would take CD money. They may have a money market sitting out there, 75,000, 100,000. They're just going to dump that into a hybrid policy.
Okay.
Flexibility is a lot better today with premiums, and it's really widened the market, opened the market to younger people too. The 40 and 50-year-olds are buying these products now because you don't need that single premium. You can do a 5-pay, you can do a 10-pay, you can do a pay to age 65.
So when you say 5-pay, you mean make annual payments for 5 years?
Make annual payments for 5 years, and then you're done paying.
Okay.
And you're guaranteed never have to pay a premium again.
I see.
So you get a little bit bigger bang for your buck by prepaying the contract as a single premium, as a 5-pay. Your benefits are going to be a little bit higher because of that.
Okay.
Now, some clients prefer not to do a 10 or 20 pay, and you can still pay to age 100. You can pay for just like you would traditional long-term care. So now they've got that option as well. So you can imagine how many more people are buying this product today than they did in the past.
Well, let's go to this here. So again, annuity contracts have fees and limitations, and there's also going to be some underwriting going on, and we'll talk about that. But the cons here, some of these cons, what you're saying, aren't really cons anymore. So funded with a lump sum, it used to have to be that way, but now there's other options. You can fund it with smaller amounts over a series of years.
Yep.
And you're saying the limited flexibility to customize coverages is changing too, right?
Yeah, that no longer is, I would not consider that a con, because you can design a hybrid or asset-based product exactly or very similar to what you can do a traditional long-term care plan, in that you choose what monthly benefit you want to have. You choose how long you want that benefit period to be. If I'm in a nursing home, do I want it paid 4 years, 5 years, 6 years? You can do that. Or you can even add inflation into these products of 3% or 5%, which you can do a traditional. So it's a very, very similar design now.
Great.
So that's improved a lot.
That is good to know. Good. Okay. So the next major type of insurance is a life insurance policy, and typically a permanent life insurance policy with a rider on it that says allows for policyholders to access a portion of the death benefit to cover long-term care costs. How do you see that working in real life?
Where we see that working in real life is typically if somebody has a need for both life insurance and long-term care, so they have a need for both, they're typically going to go into a product like this because it offers a higher death benefit.
Okay.
All right. So I'm going to buy a certain amount of death benefit. And then if for some reason I go into a nursing home, then I can access that or accelerate that death benefit at a certain rate and pay for my long-term care costs. Now, my death benefit, for example, if I bought $300,000 of death benefit, and I go into a long-term care facility and I use 100,000 of it in 1 year, my death benefit is no longer 300,000, it reduces to 200,000. So you don't get both, You know, somehow it's got to reduce that, but there is a potential, for example, in that scenario, if it reduced to 200,000 and I never use it again, then I still got a death benefit of $200,000 going to my beneficiaries.
Okay.
But again, it's a little bit higher cost product because there's more life insurance in it, which causes some additional costs inside the contract.
Right. So really does provide coverage for two things simultaneously.
It could, yes.
Yeah.
Yes.
Okay. All right. So life insurance cons, typically, again, like you said, it's a more expensive option because you're combining a high cost rider onto a high cost product,
Yep.
which is permanent life insurance. And, as always, there are coverage limitations for what that product can do.
Yeah, the one other thing you cannot do in that product is have flexibility in design like we talked
That's
about
right.
before.
Yep.
You can't get it with this type of rider.
Okay, very good. So this is a slide we put in with your input, is policies that you can buy really pay out two different ways. And the first way is reimbursement plans. So essentially, you are having to pay for the long-term care, and then you gather all that information and the bills, and then you send it into the company. They review what sort of care you got, if it's covered care, and they'll reimburse you for a portion of it or all of it up to, of course, the policy limits.
Correct.
And you typically have to do that monthly. So it's a lot of work.
Yep.
What sort of plans, insurance policies pay with reimbursement?
So what I'm seeing today is if you buy a traditional long-term care policy, typically those are going to be reimbursement. So you have to send in your receipts. A lot of the plans that we talked about here previously, the asset-based products and the life insurance products with the long-term care rider, a lot of those plans are now indemnity. So a lot of our clients like to use that.
Well, let's talk about indemnity, because as long as you're covered and are on claim and receiving money from the insurance policy, the insurance just pays the predetermined amount straight to the beneficiary, and the beneficiary gets to decide how to spend it.
That's exactly right.
So give me a real life example of what difference that makes.
Well, so for example, let's just say indemnity gives me some flexibility that reimbursement does not. So let's say I want to have somebody take care of me in my home. I'm 80 years old. I just need some assistance with some activities of daily living. I could actually pay my siblings, my kids, or even a neighbor, if they wanted to could take care of me. You can actually pay them via that indemnity check that you get each month. So if you get a check for $5,000, you don't want it, you're not in the need to go to a nursing home yet. You want to stay home like a lot of people do. You can stay home. You don't have to worry about calling a service, somebody that you don't know that's going to come in and take care of you. You can actually pay family members and neighbors. And that's one of the things that a lot of clients love about that plan. And then also with indemnity, since I'm not sending in expenses to get reimbursed, I can do whatever I want to my home for modifications. You know, if I want to put a lift on my vehicle, I'm in a wheelchair, or I need a ramp out front.
Or you need a wheelchair.
Or you need a wheelchair, you can use that money however you would like. So if it costs $3,000 to build that ramp, you can use part of that money. Usually you'll see $5,000 to $6,000 come out of that policy each month. Is typically what you would see.
Okay.
So great flexibility. Use it how you want to use it, and it works nicely.
Well, let's talk a little bit about the claims process for these policies. Do you find that one's any worse than the other, or do you have some tips for people going through the claims process?
It's really not going to be a whole lot different between traditional long-term care and the hybrid plans that we talked about. Okay. Essentially how it works is typically a physician needs to certify that you need assistance for 2 of the 6 ADLs, activities of daily living, that you touched on before. Once that's been certified, or I've been diagnosed with dementia or Alzheimer's, those are automatic triggers. I don't have to do the 2 of 6. Those are automatic triggers. So usually there's a 90-day wait. So if I go into a facility, I got to pay that for 90 days, whatever that cost is going to be. And then the policy kicks in at that point.
So what, again, what if you're having a problem with activities of daily living at home? That
Mhm.
same process you can use at home as well as a facility, as well as a nursing home, right?
Yes, it's gonna cover any of those facilities that you mentioned.
Gotcha.
Assisted living, home health care, traditional long-term care facility.
Okay.
You can use it however you want to use it.
And one of the things that I think there's a lot of confusion about is the levels of care out there in the facility. So there are facilities that just do assisted living,
Yep.
which of course somebody has to by and large, be living partially on their own and
Mhm.
partially with help. And then there's legally a whole nother class called nursing homes
Mhm.
or skilled nursing facilities.
Right.
And those are actually quite different
Yeah,
than assisted living facilities, right?
they are. That's gonna be pretty much full-time care.
Full on care.
You're to that point where you need full-time care.
Yeah.
And obviously, the home health care is gonna be a little bit less than assisted living. Assisted living is gonna be a little bit less than the traditional long-term care. So what I also see some certain clients do too is they may have other assets, right?
Sure.
So they may just partially insure.
Mhm.
They might buy one of these policies to cover maybe 50 to 75% of the long-term care, and then they'll use their other assets just to keep their premium and cost down.
Yeah. It's a great point because the last way that we see people handle this exposure is self-insurance. And so the pros is when you're paying for this long-term care yourself, you can get exactly what you need when you need it. You don't have to jump through a bunch of hoops. You don't have to um, be rubbing your hands about if you qualify for this plan or if you qualify for 2 of the 6 ADLs so you can start getting insurance money. You just pay for what you need.
Yeah.
You also avoid the insurance claim process. And I can tell you from experience, I went through the reimbursement policy claims process, and it's a lot of work.
Mm-hmm.
It's a little part-time job when you're dealing with an insurance company monthly, trying to get bills paid on a reimbursement policy.
That's a good point. And the other thing I'll mention is all of these products we talked about before, each of those carriers that have these products have a concierge service available.
Do they?
So you don't have to worry about what you just talked about. You call the carrier, they have a concierge service that helps you identify places that you may need to go to. It helps you with the claims process. They know that business. They deal with it day in and day out. So they kind of walk you through it. It's just, you nailed it. It's so frustrating to have to do that on your own.
It's really tough.
If you have to almost experience it one time to understand why you don't want to do it again.
That's right. Yep. The other thing is that these insurance policies, if they have an investment function in them, tend to be very low return options, especially on the annuity-based products. So if you do self-insure, there's often better return options for your money outside of long-term care.
Yeah, an example that I typically use with advisors and clients on that is, let's say I've got $100,000 sitting in a CD at the bank. What am I earning on that? It used to be 0.5 or 1%. Today it's higher, obviously.
Yep.
So that money's sitting there, not really generating much for return. So there's not going to be a lot of assets passing on to there's not gonna be a lot of growth there. So a lot of people will leverage that money. So they'll take $100,000 out of that CD, and then that automatically buys them about 2.5 times that amount for long-term care. And sometimes it might buy you if you put in 100, it might buy $150,000 of death benefit, but you've also got a pool of money of 250,000 to use for long-term care. So that CD will never come close.
Yeah.
To reaching those numbers.
So that's a example based on your experience of what's out and available in the marketplace. Of course, subject to underwriting, right? But a lesser amount of underwriting than the old traditional policies.
Correct.
Okay.
Correct.
The other thing is, at the end of the day, it kind of takes care of one of the issues that people have with long-term care, the traditional long-term care. If you don't need it, you haven't sunk any money into insuring against it.
Yep.
Of course, self-insurance cons, things that go against it, is very uncertain long-term care. I mean, it has gotten really expensive in the last, certainly the last 10 years, and continues to do so at a pace that's faster than the general pace of inflation itself. You actually have limited access to care options if your financial resources do run out. So what that means is if you run out of money to pay for long-term care, there's not a lot of areas out there that will accept government assistance for your care.
You basically, at that point, you're spent down for Medicaid and
Yeah,
you're getting rid of all your assets.
yep. And we're going to talk about that too. One of the people's biggest fears is becoming either a financial burden or just a burden in general to their children.
Yes, the financial burden, but sometimes the other part of that is more of a burden because they're having to get
the
they
care
got their
burden,
own life to
right.
take care of them. There's a lot of hours involved there, and it can become stressful for both parties.
That's right. And honestly, what we see is the financial stress on a couple where one spouse is needing care and the other spouse is still well, and they're actually they're having to float the expense of two different households because they're no longer living together, and that can that can present a lot of stress and a lot of financial stress on a household. Yep. So more financial aspects of paying for care. Here's a clarification. Medicare is health insurance for those over 65. Medicare does not pay for long-term care, with the exception of some very short-term coverage, and I think it's about 60 days.
Yeah, 60
Okay.
or 90 days, I
Yep.
believe.
Health insurance does not pay for long-term care. Sometimes disability insurance can, if it's related and during the working years. So that's certainly a piece of insurance to have in place. But, and another financial aspect is sometimes people are afraid, oh, I don't want to burden my children with the cost of long-term care. Well, adult children typically are not responsible for their parents' long-term care costs unless somehow they have signed up to pay for that.
Right.
But generally not responsible. More considerations for long-term care. So we talked about Medicare, which is health insurance for those 65 and older, does not pay for long-term care. Medicaid is an insurance program run by the government for the poor, and it does cover long-term care costs. Now, back to a prior point, is there is not a lot of facilities that opt to take Medicare patients. So your options are much more limited than in the open market and paying for yourself.
Historically, yes, that's going to be, you're just not going to have as good a care in those facilities. It simply boils down to that, just because they're not getting as much premium as they would.
That's right.
You know, for, or not premium, but the costs for the care each month, they're just not getting as much money. So the people that have the policies, that they're getting better care.
They get better care.
Whether we like it or not, they just are.
That is a financial reality. So of course, to qualify for Medicaid, there are lots of rules. And one of the biggest rules is you essentially can't have any money to your name. And so you're at the end of your money, and Medicaid actually keeps track of how much they spend caring for you. And at the end of your life, they will bill your estate for that amount of care that you've accrued under their spending, basically. And so there's a lot of discussion around that. And I know that there's some strategies to actually qualify for Medicaid. And I just go back to that Medicaid is an insurance program for the poor. And so, you know, that's, talk to your attorney if you want to address those things. But again, the big deal is when you have a well spouse and a sick spouse, and how do you protect assets for the well spouse so they can have a life maybe after the sick spouse passes away in a number of years. Okay. Really sticky situation sometimes. So reach out for help. But just a few little things to wrap it up here. So other considerations for long-term care, and these come from clients that we have going through these situations comes from me because I've personally gone through this situation with my mom. Powers of attorney are a big deal. Powers of attorney allow you to make medical and financial decisions, typically for a parent. It can be for anybody, but typically parents want kids, elderly parents want their adult children to have powers of attorney in their life to help them out, to write checks, to pay for bills, all that stuff. And I will say, get it in place, because if you start to have cognitive decline in your parents' generation, there comes a point where you can't get a power of attorney for them after a certain point. Their attorneys won't allow it. Basically, hey, this person has to have capacity to turn over that power of attorney and sign a legal document. So get it in place so it's there when you need it. This applies to, I would say, your parents. It also applies to your kids. You know, if you're in your 50s or 60s, who knows what's going to happen? But it sure would be nice if you needed your kids to step in and help you, that they could, because they had powers of attorney. And a little recommendation there is, when you have that, scan them and email them to yourself. You don't know how many times I got to the front desk of a medical building somewhere with my mom, and they said, "Oh, I'm sorry, as her son, you can't make decisions." I'm like, "Well, here's my power of attorney, and I'm going to email it to you right now. Did you get it? Okay, now I can make decisions." Okay. So have that available, get it in place, work with your attorney, and that goes for estate planning in general. Generally, I've found parents need help before you think they do. Think about that relationship. It's they don't want to let their kids know that they're having problems with anything. There's pride there. There can be generational differences, right? The silent generation, the baby boomers, hey, we have it all together, we're good. But again and again, they actually are needing some help and tend to hide things that are happening behind the scenes. And an example I have is, we took my mom out when she was starting to have some problems, and we're at an event, and she leaned over and said, "Hey, do you have anything to eat?" And I said, "No, why, are you hungry?" She's like, "Yeah, I've forgotten to eat today." And it was 5 p.m. Right. So it's like, oh man, like, what is going on? She can't even feed herself. And it's tough when you're not around them every day. So I do encourage you just to poke around, because your parents probably need some help before they ask for it. And this last one, I say tongue in cheek. It's supposed to be a little funny and often elicits chuckles, but it's dead serious too. Is the best long-term care policy to have is a daughter in town that loves you. And I say that because not all kids have great relationships with their parents. So it really behooves you to have good relationships with your children. And not all kids live in town that you do. So to have someone close and that can stop by often makes a really big deal. And why a daughter and not a son? Just because my own experience, I have seen a way that a daughter can care for a mother that a son cannot. And that's it, just from a personal experience. So when we step back from all this and look at all these ways that you can handle this type of expense, how do you see people handling it the best?
Well, I think the first step is they have to have that conversation with their financial advisor.
Sure.
Number one, they've got to have somebody that knows the family, knows the assets, what they're trying to protect. That's number one. And then number two, I think you need to have that second part of that conversation is, do I have the ability to self-insure?
Yeah.
Maybe you do, and maybe that's the route to go. If you don't have the ability to self-insure, then you need to talk about the different plans that we discussed today. Which one's going to be right for you? There's a series of questions you're going to go through. You're going to go through the assets and figure out what that's going to be.
Yeah.
But I think the first step is, don't try to do this stuff online. Don't believe everything you read online. There's a lot out there. Your financial advisor knows you the best. They're the ones that are going to lead you down that path that's going to be best for you.
Yeah.
So I think that's really what it is. And I always suggest to advisors and clients is, talk about those things, but then look at all the options too. Look at a traditional long-term care and an asset base that have very similar structure. What's the premium difference? But on the back end, what's the cost benefit?
When do you
Okay.
see people, but when's the prime to get long-term care insurance in place?
That, I would say the younger the better, but let's be honest, a lot of 40-year-olds aren't necessarily thinking about that yet, unless they had a parent that might have went through this, to a long-term care or needed home health care. Go back to your,
When is the optimum
the
time?
age then
Yep.
would be probably somewhere in your, I'll call it 55 to 65 is kind of the sweet spot. I see a lot of clients buying it in there because they may have that single premium, that 10 pay.
Mhm.
They're starting to think more about long-term care and protecting assets for their
They have
kids.
some extra cash flow to put into something to,
They do.
cause these things aren't cheap. You gotta put some assets up. You gotta, put part of your net worth towards this because it really is a protection tool over time.
It is, and we still have 70-year-olds buying this. It gets quite a bit more expensive. I always tell clients it might be a little too late. You should have done this when you were 60 or 65, but we're also seeing more, believe it or not, buying in their 40s now because they have that option to buy it at a lower premium and pay it for lifetime.
What are some things that you see disqualify people from being able to get some of these policies in place? Like from an underwriting perspective?
Yeah, quite frankly, it is absolutely all over the board, but we do see some cognitive things that come up that may prevent them from getting a policy. You got to start thinking about, many people look at, oh my gosh, I had cancer, or I had heart disease. That's not going to rule you out. That's more of a mortality issue than it is a morbidity issue.
What's the difference?
So mortality is on life insurance,
Just
they're gonna
passing
underwrite
away.
you, what's your chances of living to age 90 or 95?
Gotcha.
Morbidity is more, what's the risk that they're gonna go into a long-term care
I
facility?
see. Okay.
So the things that we're typically seeing is somebody that may had a hip replacement, had complications from that, or continues to have knee issues or back issues that might put them into a long-term care facility. Somebody that's got severe arthritis. You kind of think about it a little bit differently than life insurance, quite honestly, because you're thinking about those things that might put you into a long-term care facility, not necessarily dealing with mortality, but what's the odds that you're going to go into one of those facilities?
It doesn't kill you,
Right.
but you need help with the activities of daily living.
Yeah.
It's more of a handicap than it is a death thing.
But it's really, really important because people think they can't get long-term care because they have, let's say, diabetes. Very common one we see is diabetes. There's a lot of diabetics in this country right now. That does not preclude you from getting long-term care. There's certain times it will.
Yeah.
But we write a lot of diabetics that get long-term care coverage.
Will it keep you from getting as a high limit?
No,
Really?
no. It might change your class a little bit.
So it might change
Which
the
would
cost of it.
potentially change the premiums some,
Okay.
but you're still buying the same benefit, maybe at a slightly higher cost.
Gotcha.
Yeah.
Okay. All right. I think that's it. Do we have any questions, Galen?
One question is, what type of assets can you use to pay into the hybrid policies? Thinking like pre-tax versus after tax.
Can it be from a retirement account?
There is a way to do it from a retirement account or from an IRA. Obviously, you got to take RMDs at some point in time. You can take your RMDs and buy the policy. But typically what I see is if somebody's sitting on a fixed annuity or an indexed annuity, they could take money from that and purchase a policy. But usually it's non-qualified money that's being moved into these products.
So money in your bank account, money is saved up and
Non-qualified annuity. If you've got an annuity sitting in an IRA, it's going to be difficult to get that over. We can do it. There's a company that'll do it, but it gets a little bit more complicated.
Okay.
So I would say 90% of the time where we see that money coming from is a CD, money market, or an annuity. That's coming up. You bought a 5-year annuity, it's coming up. I want to leverage those dollars differently. I'm going to go buy one of these policies with that money instead.
All right, that's it for today. Want to be respectful of your time. Oh, right on spot, 12:45. All right, everybody, if you have any additional questions, please reach out to us at Compass Financial. We'd love to hear from you. Jerry, thanks for coming in today.
You're welcome.
Yeah,
Enjoyed it.
interesting things going on in the market, and we'll keep everybody up to date on what's happening. Have a great day.